Good morning. I'm Alex Abramov. In the next 30 minutes, we will try to touch upon a very large topic, risk management, technology, and data, and how it's all integrated together. We probably could spend the rest of 2 days talking about this topic. So we'll try to address some specific issues and challenges in this area. So we'll start from introduction of the panel. Joe?
I'm Joe Compton. I'm with Skoda Minotti. I spent the past 25 years of my career doing IT risk management for community banks and financial institutions on both coasts and everywhere in between.
I'm Jon Asprey. I lead the strategic consulting group at Trillium Software. So we are a provider of data quality tools to industry. However, we also have an advisory practice, and I spend a lot of time advising our banking clients and our financial clients on data governance, information management, and regulatory compliance.
And I'm Matt Bienfang with Blue Metal Architects. We are a modern application company who is focused on financial services specifically, and we take a really holistic approach to delivering our clients' exacting needs around big data, social, user experience, and mobility. We're very happy to be here and glad to speak to you about big data today. Thanks.
And I am not part of this panel, but I'm jumping in because during this panel, especially since it's right before lunch, if you have questions during the panel, you don't have to wait till the end. Raise your hand. I'll bring a microphone if you can come up right by the coffee machines. I think it'll make it for a better panel. If you have something that's on your mind right away, we might as well ask the questions either individually or to the group. So I encourage you to do that. Go ahead.
Please do, because this is definitely a two-way street, or many-way street, which we would like to open now. I'm Alex Abramov. I'm with ISACA. I'm also working in financial markets during the day. I'm working in IT governance, risk and control area for the last 20 years. The risk management, enterprise risk management, I think that everybody has a different view of that and what the components are and how actually this being perceived by different areas is important to ascertain. So what I'd like to ask to start our panel to give us short definition. What do you think enterprise risk management is and how important it is for technology?
Okay, I'll start, no problem. I didn't really give a background, but previously to my role at Trillium, I also worked for Deloitte, which I'm sure many of you know, within their enterprise risk services team in London. And really for me, I don't really want to give a definition of enterprise risk, but what I do want to do is set a bit of a scene. And for me, a lot of our work there was focusing on processes and controls, and obviously where there is a lack of process or a lack of control, risk is introduced. So we were spending a lot of time identifying that. But to put a data spin on it and to link it to my current role, one of the things that I see which is very powerful for our banking clients is that trends or inconsistencies and problems with data quality are often evidence of controls and processes not working effectively. And therefore, you have the evidential side of things that by managing data closely and correctly, it will illustrate where your processes and controls are not working effectively. But also by putting proper data management in place, it's another level of control that you can have in your organization, which reduces risk.
I'm going to avoid giving a definition as well, but he did it much more eloquently than I could have. But what I think, where we all miss the boat, you know, whether you're in the financial services world or you're managing a technology company, really is everybody's so focused on the big breach. You know, what are we going to lose? How are we going to get attacked? Where's it going? And we kind of lose the focus of really understanding what the data is in our business, why it's important, and where's it going, and who touches it. And I think once we get back to the basics in terms of learning how to figure out what that is, and in the scope of big data, being able to kind of track that with automated controls, that's going to be the real game changer in terms of us getting a much better handle on enterprise risk and managing the risks associated with the information we're collecting and responsible for.
So, my world, just to give you a little background, I spent 15 years as a head trader for a large insurance company, and then moved into EVP role of operations, and risk meant something totally different on the trading desk than it did once you hit the operations floor. And when I look back, it took me a little while to really identify, okay, what are we trying to manage here? And it's really people, process, and data, and anything that touches the enterprise, broadly speaking. I don't know that there's any one definition of enterprise risk. I think it's all in the eyes of the beholder to a certain extent. But there are certain processes and certain steps that we all can take that are sort of uniform in the industry and how we look at things. In this case, I think we're kind of focused on the data element. So enterprise risk around data. I look at that and I say, well, it's almost anything that touches my tier ones. It's almost anything that influences a decision by one of my managers or by even my trading desk. So there's enterprise risk represented in almost all things, but in this case in data.
I'd like to add one comment. Over the last 4 or 5 years, we as a firm, and me personally, we've done a lot more work with CROs than we've ever done in the past from a data analysis and technology standpoint. And we worked on a large Basel II program in North America. It's an international bank, but they have a headquarters in Chicago. And one of the things that I'll take away from the analysis that we did, that bank had a supervisory note saying that its information management was not sufficient under the Basel regime from a regulatory standpoint. And we worked on a program that was supervised by the Fed to put a more robust data quality monitoring and analytics environment in place. And one of the things that sticks in my mind the most about that, the biggest issue, we confirmed a lot of their fears around some of the things that they thought were problematic in the data. But the biggest thing that the CRO took away from the engagement was we found 67 issues or scenarios that the CRO was not aware of. So situations in the data that looked suspect, that may have been material to their credit risk calculations that weren't currently unearthed. And obviously the power for him and the value in terms of managing risk is he needs to know about those 67 things before the regulator finds them or before some kind of incident takes place. So it's kind of an early warning system, being proactive.
Right. So the common thread, what we're hearing is that risk management data and data management, data security are really very closely linked. So if we're looking on a risk event over the past, say Barings 95 or UBS 2010, what type of risk is this? We heard about credit risk, John mentioned, market risk, model risk, counterparty risk. So the risk in this situation was operational risk, which is sometimes being overseen by the community and by the over risk practitioner as well as within the bank. So operational risk, that leads to things which comes to the front pages of a newspaper when person have inappropriate access and the company has inadequate access control, and when we have segregation of duty issues and toxic combinations. So we shouldn't forget about that when we're looking at a framework of risk management, risk management data and technology, we need to think about the assets and we need to think about controls to protect these assets. So with that, I would like to ask a panel, looking back, what technology innovations were helpful in addressing enterprise risk?
So I think the move into the world of aggregation and data aggregation certainly was a big one. And on the forefront, just to skip ahead a little bit, things that will impact us, the adoptance, utilization of big data, and some of the open source solutions that are out there, whether it's Hadoop or one of the others. Unstructured data, I think, has been used in the finance realm, at least from an investment decisioning standpoint, for quite some time. Most asset managers, or at least the latest report I saw, said half of them use unstructured data in their investment decisioning process. It's not quite trusted within the enterprise yet, or we haven't really figured out how to use it. It may be that the tools just aren't enterprise ready yet. So where I think everybody in the room probably has, if you're a large enterprise customer, has someone playing with Hadoop today. It's just not quite there yet from an enterprise level. There are certainly some companies taking it there, but I think going back to the specific instances of the whether we're talking about the 90s or 2008 or whatever it was, we spent a lot of time collecting data, structuring data. I think the data was all there. We just didn't have any good way to visualize it and consume it. We had so much of it. It was somewhat disparate, but it was in certain geos. You had operational data. You had other data that wasn't in the control of people that could make decisions, and they had no good way of looking at it. So I think some of the visualization tools that are out there that allow us to really dig into massive amounts of data as beings we don't see in rows and columns. We can only capture so much and ingest so much. So some of the data visualization tools that allow us to look at hundreds of millions of rows and take away inference from that, I think those are the tools that are sort of on the leading edge of giving us better controls over data.
Okay. There's a couple of points I want to make, two differing points, but linking to I think what you said around counterparty risk and the financial crisis. Still, we do a significant amount of work, continue to do a significant amount of work around linking and aggregating clients, legal entities, connecting them together and managing the exposure across those legal entities. And I've got an interesting insight. There was a previous presentation around FATCA. One of our clients, which is based in London, we're working on a FATCA program for them at the moment, and they did their initial assessment. There's been a lot of activity in Europe on this over the last 12 months. They have 150 client onboarding systems across their group that are implicated from a FATCA perspective. So that's 150 different databases with client information in them that they need to connect and get a single view of. And I think this concept of single customer view, master data management, it's an ongoing thing, and it continues to evolve. And therefore, I think that's a big area that we continue to see involvement in. There's another point that I want to make also, which is around giving what I would call the business users or the consumers of information more flexible and rapid access. So I think you talked about visualization. Certainly, one of the things that I see that's common in large financial firms is that IT provisioning is incredibly slow and difficult to manage. And what we see an increasing number of requests for from areas of the business like risk, finance, treasury, is for them to be enabled to get their own rapid access to account and client data and not to have to wait 6 weeks, 6 months to put in a request to IT, draw up some requirements, get it changed. They want quick access. And I think we talked about this earlier. At home, we're so used to Google, iPads, iPhones, yet when we're in a business situation to get a new report written, certainly in banks like Barclays and HSBC, it can take 3 weeks, 3 months even to get a report the way you need it. And, at home we have a much different experience, I think.
And I'm going to take it kind of a step backwards to a more primitive, set of tools that are continually evolving today. I think, with the establishment of COVID-5 and that starting to get rolled out into, more massive use, and ITIL and some of the more structured way to begin to look at controls and to document what it is that we're doing, that's going to be the game changer. And the AICPA came out with the new standards, the SSA 16 and the SOC 2 and SOC 3 reporting. We're at the beginning of kind of understanding and talking about controls that we have in place. So if you're one bank, transacting with another bank, or if you're a bank interacting with one of these vendors in the rooms, you need to understand the controls that they have in place if they're touching your customers' data or non-public information. And, vice versa. They need to understand the controls that you need to have in place or what your requirements are, just from a pure vendor relationship standpoint. So I think these frameworks that are evolving and will continue to evolve within the next 5 years ultimately are going to be the real game changer. The technology is the technology. I mean, it's all cool stuff, but at the end of the day, it's just, rows and columns of data that we have to manage and make sense of. But, and there's, it may get processed a lot faster, it may get delivered, via a way we haven't even seen yet. But if we don't have a way to kind of organize the control around it and understand and make sure that we're on the same page, it's tough. It's very tough to manage, and that's the challenge that we have today.
I'd completely agree with that. I think, obviously, as a firm, my firm's a technology provider, but obviously, from my point of view, I work on the advisory side, and quite a lot of the work that we do is around data governance, which has become a bit of a dirty word because I think people have tried it and it's failed, but governance is what people do every day. They just need to formalize it, I think, But certainly one of the areas that we see a lot of activity is around defining standards for data. So what does good look like? What is acceptable? What's the minimum level of quality? And I think this goes to something else that we talked about around control, which is what is this data actually being used for? What processes is it driving? And therefore the level of quality required will be linked to what it's being used for. And so firstly, you need to understand the flow of information through your firm, where it comes in, where it's modified, what it's then used for downstream, and then build your standards and your controls and your constraints based on that usage.
That's a great insights, so I'm sorry, I'll pass it to Matt
And
as
that's
well.
not about technology at all.
Absolutely. If you're hearing the answers, it's really talking about Basel III framework, people, process, technology, external events. So we're hearing about technology first, about Hadoop, data visualization, really, still on the top of that curve we just seen on the previous presentation. We're talking about frameworks. I'm very pleased that COVID was mentioned because I'm ISACA director. This is ISACA framework. And other frameworks as well, more public and less public in a way that practitioners adopting them, and of course more process-oriented type of things which John was talking about, taking handle of the data which affects all types of the risk. And there are many ways, people looking back on 2008 crisis, which we're still dealing with, and some of them is counterparty risk, but it's also operational risk because complexity of the models create this type of gap where people do not understand the product, and that brought in part this type of risk. So all the components of the risk are definitely influenced and really dependent on a quality of data and an underlying technology. So Matt, you wanted to add something?
No, I just wanted to reinforce that notion of the quality of data and how that relates to, the plethora of unstructured data that's out there, whether it's, demographic data that by itself is very innocuous. We don't look at that as with a lot of risk, but if we take that and we marry it up with a few more things, and you've got someone in operations or some business analyst that's now looking at something and getting some correlation out of that, and then it's feeding into one of my tier 1 applications, and that whole risk profiles of what was, on the surface relatively harmless data suddenly becomes much, much more risky in terms of, okay, how often am I getting this data? To your point, is it, what days is it consistent? What days do I need to maybe source it from someplace else, or maybe warn my business users that, we see around the holidays just the flood of transactional data gets too big, we don't want to trust this, just FYI. So we do start looking through a different lens when we start looking at some of this unstructured big data.
Absolutely.
Alexander, if I could jump in very briefly.
Yes.
A couple of things. We are going to break for lunch on time. I don't want to rush you guys, which means if you do have any questions, just get my attention. Brad Simpson has said to me, I am not going to be the person waiting and holding people up for lunch. So we're going to break for lunch on time, get Brad in after that. He's also got a presentation he wants to hand out to you. So again, if you have any questions in the next few minutes, please raise your hand, just get my attention, come up over here. I'll give you the mic and you can ask. And the mic is simply because we want to record the question as well as the answers. So take it away again, Alexander.
Please, any questions?
Anybody playing with any of the Hadoop stuff out there today? No? Hortonworks, taking a look at that stuff? No? Okay. How about looking at real-time data? I mean, that's one of the areas that we see a lot of investment today, and I think that was probably, if we look back in 2008 and the sort of crises that we've had in the past, is that, again, I think the data was there, but it was always a month late. You know, we never really knew there was a problem until after the fact. So a lot of the tools that are out there today to look at streaming data, bring it in line, and visualize that have had a significant effect in reducing the risk.
I would add to that, just that what I've seen is you've almost got two tiers of speed within financial firms. Obviously, on the transactional side, you mentioned real time there, the speed of transaction has increased rapidly. Timing is everything. And when financial firms try to govern their data, what they have to balance on that is getting transactions made, because that's the most important thing to them. They cannot hold up transactions. And therefore, I think what I almost see as the data volumes go up is the front office processes are getting quicker, but the back office reconciliations and data management at month end is getting slower because it's harder to do. It's less regulated or less controlled, and therefore there's a bigger challenge behind the scenes to get your month end. And I work with a client that spends almost 3 weeks a month doing its month end. So, you know, they get one out of the way and they're straight on to the next one because their month-end processing takes so long.
Right. And Matt mentioned about some seasonality in the data. Do you know that fraud is also a seasonal type of event? It is. So when do you think the top level of fraud in certain areas would be observed? Summer, spring?
Fall.
Fall. Depends. So what I had in mind is summer, because a lot of people taking vacation, and at that time segregation of duty is not as strong as during the year. So analytics and predictive analytics can really determine, you know, your factors of fraud and understand, you know, where things may be coming from, and have your more heightened awareness during certain period of time to understand when the things may go wrong and when the fraud may be perpetuated, and using temporal analytics to be able to bring variety of events together and understand your clusters and attack this type of this type of risk, so to speak, in addition to any types of risk. But Matt, you had something in mind when you said flow.
I just figured they were all on vacation anyway, so maybe.
Right. So the same thought, right. Any other questions before we'll be closing this panel, but we'll be here for 2 days. We'll be happy to talk with anyone.
It's Monday morning, I think.
Okay, I'll try my best.
Hey, I was on a flight last night. Come on.
Right. Do we have more time, or we?
Sure, yeah.
Okay.
Hey, you've got
excellent.
time.
Okay.
Final
So,
thoughts, whatever you want to do.
I was feeling that we were getting closer.
No.
to action.
I just
So
want to let you know.
I'd like to ask another question. You know, so we
Sure.
we talked about.
We do have a question.
Oh, great.
Sure. I'll say your name.
Sure. This is Joe Sinzer. I'd be very interested in the panel's views of LEI, the legal entity identifier regulations that have come down the pike recently. And all of us in this community, either from a technology provider perspective or from a bank perspective, are having to deal with this. And I'm particularly interested in hearing the global sense of this. Is it going to happen? When is it going to happen? And what form is it going to take? Because it's certainly more data. Is it 10 numbers? Is it 100 numbers? Is it whatever? So I'd be very interested in hearing the views. Thank you.
Okay, who's going to be first?
Yeah, I'm happy to take it. We're actually engaged with quite a large number of global banking and markets divisions within financial firms, and certainly legal entity identification across significantly in the UK and the US is a major program that many firms are working on. I think the good thing is that through making the LEI a mandatory and an official program, which I believe will come together, I think it's moving and it will take time, but it is an industry initiative and I think it will happen. Supports many of the internal initiatives that companies are currently involved in. So the machinery and the processes that an organization needs to put in place to get a single entity view are currently underway, I think, in many cases. But the LEI adds weight to that. So I mean, we used to work, or I did a large program with HSBC back in 2006, and the biggest gift that the risk team said that they had there was Basel II, because it gave them the excuse to get the budget, to get the momentum, to get things done. So if you have an industry initiative and a regulation like LEI, which is wrapped within Dodd-Frank, that forces organizations to do these things, gives them the catalyst, I think it really helps the risk professionals within the firm to bang the drum and to get these projects funded and to get them happening. So I think it's a great thing that the industry and that the regulatory environment is pushing this. I think it will help many organizations get it done.
Joe, Matt, anything to add to this?
When we can create some standards that have benefits beyond sort of the regulatory eye, I think that's great. I think it will take time. It's not, when we talk about Europe, I mean, again, we all know it's not a group of federated states. So I think the duration that you're looking at is probably a lot longer than any regulator wants it to be, but undoubtedly it'll happen.
Right, so I think in the question whether some degree of skepticism, is it really going to happen, because the movement toward common standards for data is not new, and there are several false starts and failed initiatives in that. So I'm also more on an optimistic view on that, because there's strong sponsorship from organizations like DTCC or SWIFT. There are also some competing models from FIG Group, Alan Grody, if you read some of his articles about that. So I think, but it's not only that, I think that there are also more common understanding within the industry that we are really going to benefit all without really creating single competitive advantage anywhere. And the savings and efficiency and degree of compliance which successful AI implementation will bring will outweigh any other risk and investment which people will need to take into that.
There is one point I'd like to raise, and it's really, just to put it out there, it's more of a rhetorical question or just a discussion point, is that I was speaking at a financial conference earlier this year, and we talked about LEI, and we talked about the regulatory pressures that many financial firms face. But obviously one of the things that many of you here are dependent on that isn't scrutinized, I believe, as hard as it could be, is the data providers. So the rating agencies, the data providers who are supplying that counterparty and market data. At the moment, they're not that beholden for the quality of the data they supply. And many financial firms rely very heavily on it. And interestingly, when we've done analysis for clients, so they look at their own data, but then they turn it on the third-party feeds that they get, they find a lot of issues, and that third-party data is left wanting in many situations.
Right. So John mentioned about multiple data providers. I think those of us who work in the financial industry know that every institution may have a dozen or more than a dozen different providers. And of course, the sourcing people wish to bring it down to maybe one or two. So question to the panel, a question to the audience. Do you see this type of consolidation happening, that we will see more comprehensive universal providers of a variety of the data which we're using for our data management?
Not willingly will we see, I mean, certainly there's some aggregation that's going to happen. So-and-so will buy so-and-so, but I think, we're a marketplace that's sort of built on inefficiencies, and we take advantage of inefficient markets all the time. So we sort of need lots and lots of different data out there so that we can interpret it differently. It sort of provides some of the fundamental structures and premises of our marketplace. So I hope that we don't go to just a few data providers. For my sake and others, I think, the more the merrier, and I'll be able to read that whatever way I want and make an investment decision based on what I think is appropriate.
What I certainly see, I see a desire, but I also see a movement to this outcome is financial firms scrutinizing the third-party data they get much more rigorously than they currently do. And I think using that to negotiate their costs and their pricing agreements with their third-party providers. Because at the moment, I think when I speak to many people who are responsible for reference data or market data, they feel pretty much, you know, hamstrung and beholden to the data providers, and they know they're buying the same data over and over, and they know that their contracts are pretty restrictive. So I think that they're looking for a way to take some control of that situation and negotiate. And I think if you can prove, you know, and I won't pick anybody, but if you can prove to a third-party provider that their data is not as good as they think it is, you know, I think it gives you a much better negotiating position, because I think many banks are trying to drive down the cost of reference data within their firm.
And I agree. I think the competition is good. It forces everybody to work really hard and, you know, continuously improve the quality of the information that they're pushing through. And if it consolidated too much, I think it would be bad for the banks that are buying this data.
So good news for the data vendors then. So we talked about the innovation which we observed over the last several years in technology and governance and the frameworks. So what other unresolved challenges we're seeing right now which would be something which industry will be looking to address by technology vendors and by themselves?
I'll take the first stab at that if you like. I think for me, one of the biggest challenges that's going to be addressed over the next few years is developing what I would call an enterprise data standard, or enterprise data standards for key pieces of information within a firm. And I look at that from two perspectives. It's content, so what are the standards for the content of the data? You know, what's there? Is it in the right format? Is it in the right structure? But also then standards around usage. So what is this data certified for usage for? You know, which processes can it be used for? It may be able to be used for, let's say, a credit risk calculation, but it may not be suitable for a securitization pool or something like that. You know, you've got to make sure that whatever you're doing with that data, is it fit for that usage? So I think standards around content and usage are important.
I got to go back to the visualization side. I mean, I think at the end of the day, we can only ask the machine to make so many decisions for us. In every decision channel, there's usually some human interaction at the end of it. So I really believe that the data viz side is the technology that's going to enable the data that we do collect and standardize, and we make it consumable that way. So I'm looking forward to seeing that really develop much further than it is today, and then develop across devices so that we have it not only on the desktop, you know, highly performant machines, highly performant data, but right down into the tablet, because, you know, my traders would want to walk away from their trading desk and go talk to somebody else and show them what they're looking at on a tablet. So to the extent we can take data and provide it on a small form factor, lots of it, I think that's the technology I'm looking forward to.
Right. So I'm hearing about still, you know, improving of the data quality, and I think we're also hearing about improving the mechanism of delivery, the right data to right people. The efficiency of delivery is very important, you know, from many perspectives. So we're looking for productivity, that people only looking for the subset of the data they're concerned with. But there's also other side of that information security. If we have an official entitlement model, and I'm speaking as operational risk and IT risk professional, if we have the efficient model, we're really improving the information security as well. Because, you know, if we're looking into report generation of the data, we may be looking now for reports of quantity of one, fully customized report, based on the right to know for the individual who can see the data. Versus, for instance, one of the bank I'm familiar with, you know, in one of the areas, over 20,000 reports, and some of them were not accessed, you know, 10,000 of them were not accessed within a year. So think about efficiency from that perspective. Standard reports, that's a breeding ground of people getting access to information which they're not supposed to see. So whereas when they would be able to log in and authenticate it, we saw several ways of good authentication technology on the previous presentation, and see the right data, that the fraud factor would be definitely controlled much better. Any other thoughts panel would like to share with the audience on this? Any questions from the audience? So I'd like to thank the panel and thank the organizers and the sponsor for this conference.